Of cash equities trading for this Tuesday morning. Here are your headlines. The cash trade is just less than an hour away, and in focus, Jay Powell. In fact, the cash trade is right here and now. And in fact, in focus, Jay Powell reiterates he sees inflation as transitory as the Fed chair gets ready to testify before the House today. Equities continue to rebound. But Fed voices vary. Kaplan wants to start tapering sooner rather than later, and Bullard gets ready for upside risk to inflation.
Morning, traders. We sold overnight Swiss franc, and I wanted to show you we made overnight £3,000. As you can see, we sold yesterday 11:30. I put the price, time, everything. So we made a profit on Swiss franc. Okay, all of you guys, if you placed stop on profit yesterday, just before we closed yesterday trades, you made a profit already. If not, you're already in profit. You can start placing, as you know, as it says in your strategy, your stop on profit. Okay, good trade, well done. For all other guys who want to find out how we trade, you need to get a strategy. It's available on companyeye.co.uk. Okay, let's move on, and I'll speak to you later, guys.
Yesterday, so stocks in Asia have followed their US counterparts higher following Fed comments. Chair Jay Powell has reiterated he sees inflation as transitory. Meanwhile, other Fed officials called for the central bank to be more attuned to inflation risks. Let's talk about where the Fed goes from here. Karen Ward, JP Morgan Asset Management EMEA Chief Market Strategist, joins us now. Karen, it's obviously from a European point of view, European stocks point of view, really important to watch this Fed narrative because it seems to tie so much into reflation expectations or the reverse of reflation expectations, depending on which day we're talking about here. Today, we seem convinced that the Fed, yes, it's a little bit more hawkish at the margin, but it's only going to withdraw support very gradually. Is that where your focus is?
Yes, I think that's right. I mean, first of all, you're completely right. It feels like everything, all the decisions you want to make in asset allocation at the moment stem from where you think that 10 years going. So the growth versus value, the US versus Europe, tech versus financials, all of this really does hang on that 10-year yield. I think the message from the Fed is, as you say, it is time to take the foot off the accelerator. We have come a long way in the last 6 months in terms of the reopening, learning about the strength of demand coming out of the pandemic, but also learning about the success of some of the support schemes. In the US, the fiscal stimulus, in Europe, the labor market support. So basically, we're coming out of this pandemic in remarkably good shape. And I think, therefore, the central banks are right to acknowledge that. They're right to mention that the balance of risks has shifted and to ease their foot off the accelerator. But they're not going to be in any hurry. I mean, I think my interpretation is they will probably end up being too late and therefore actually be slower, but have to do more in the longer run.
And which are the assets then that are at risk? Because even if it's not going to be a hurry, even if the Fed is not going to about turn very quickly, Karen, we are still then we are now watching for where the talk of taper turns into the actual action of taper. Clearly, you know, the Fed has been buying treasuries, they've been active in the mortgage market. Which are the assets that you're focused on then that have really gone too far with all of this generosity from the Fed and also, I suppose, from fiscal authorities?
Yes, well, I think it's going to create us some volatility and days where nothing does particularly well. I think we've seen already over the course of this year that, when we have a miscommunication or a misstep from the Fed and we have a particularly large move in the 10-year, then nothing does particularly well in that period. And there are going to be days like that. I think we should just brace ourselves for that volatility and not lose our head. I think if we see this sort of sustained upward march, then it might act as a little bit of a headwind for some of the areas of the market that have really benefited from zero rates and flat curves. So I'm thinking here, some of the tech stocks, some of the growth areas of the market. They've still got very strong earnings, so I'm not desperately worried about what they do, but I think it will act as more of a headwind. And then on the other side, however, I think you're going to get those areas of the market that were the real losers of zero rates and flat curves, such as financials, really catching up, which supports the overall market narrative. So I think that broad markets will still be okay in a rising yield environment, but because the earnings expectations will be rising, but we're definitely going to have days where screens of red, and I think we should just not get too alarmed about that.
Okay, so we brace ourselves for that. And you still believe then in this rotation into some areas of value. Karen, where is it that you see markets well supported by that theme? Is that a very much a European trade?
Not just Europe. I think actually areas of US values still look attractive. I think the financials, I do think we're going to come out of this with central banks being able to get off the zero bound, even in Europe. It might take a little bit of time, but ultimately I think that those risks of negative rates, which have really plagued the financials, will recede. And I think we're going to have a credit cycle again. We're all focused on government debt, but we haven't realized that households have done a pretty good job of paying down debt in the last 10 years. So that's all going to support the financials. But I do think it will play to Europe's favor. Not only have you got some of the financials heavy value heavy areas of the market in Europe, but I think Europe's really going to be one of the beneficiaries of the focus on sustainable investing.
Yes, we'll certainly get to that conversation shortly, Karen. Just on that, on the credit cycle, I mean, one of the features of the bank reporting season, certainly in the United States, was the fact that many people had more money than previously because of fiscal generosity to some extent, and so hadn't needed necessarily to go out and search for credit. Do you think then that goes away and we're back to another consumer credit cycle?
Yes, in time. And then I think on the mortgage side as well, I mean, housing markets are booming everywhere. I know earlier you were having the discussion about, is there just too much liquidity sloshing around the system? I think that the housing markets in the developed world, the fact we're seeing double-digit house price growth in many regions, is again, we're entering the early stages of a new housing boom. So that all supports lending growth as well. And you generally get consumer loans on the back of that later on in the cycle.
Karen, thanks very much. Stay with us and we will get to those conversations around green finance, green investing. Karen Ward, JP Morgan Asset Management, EMEA Chief Market Strategist. Thanks very much for your thoughts so far. Coming up on this programme, we'll also be speaking to the New York Fed President, John Williams, later in Bloomberg programming. Don't miss that exclusive interview at 2:30 p.m. at UK time. Coming up, though, here, how can markets help the fight against climate change? We'll discuss a new plan by the IMF on carbon pricing. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. Just coming up to 10 minutes into our European trading day, and things looking pretty mixed, actually. Flat across the Stoxx 600 as a whole. The FTSE eking out some gains. The DAX retreats a little. Let's have a look at some of the stocks that are individually then on the move, and indeed the energy sector, which is in focus. Let's start with Grand Vision, though. Grand Vision, the Dutch retailer, down by more than 8%, as you see there. EssilorLuxottica, the eyewear manufacturer, saying it's reviewing its options in the planned takeover of this Dutch retailer. Because of some legal changes, it's been made easier for them to walk away, so they are reviewing their options as it stands. Kingspan, construction business, an Irish-based insulation business, they put out a trading update. The momentum they experienced in the first quarter, passing through into the second quarter, so that's seen as strong news for that London-listed business. And the stocks, the energy stocks sector, you can see they're up by more than 1% as a result of, well, we've got slightly firmer prices for Brent, $75 a barrel is the handle there. WTI retreats just a touch at 73.53, but the general direction of travel in recent weeks has been upwards for oil prices as we head towards that OPEC Plus meeting. What kind of pressure will there be building next week for those big energy players to increase supply to the market? We will watch that with interest. Now, on to other matters, green. And last week, the IMF proposed a carbon price floor as a mechanism to slow rapid climate change. The body now says climate change presents huge risks to the world economy and steps need to be taken to counter it. The carbon price floor would be or could be worked out for each country based on its level of development and is part of a range of plans put forward for discussion by the IMF. Let's get the thoughts on carbon pricing and other matters with Karen Ward, JP Morgan Asset Management's EMEA Chief Market Strategist. Clearly a lot of people's attention turning to investment opportunities in the ESG space, in the green space, Karen. And I wonder what you make of carbon pricing as a part of that. The IMF talking about a differentiated carbon price depending on the nation's level of development, either $75, $50 or $25. How much does carbon pricing factor for you into as an important market mechanism?
Oh, it's tremendously important. Certainly our opinion is that these factors, and not just E, but increasingly S factors as well. We're going to hear government coming out with lots of new policies and regulations in order to try and meet these environmental and social objectives. And as investors, we've got to have our toolkit ready. We've got to be thinking about how this is going to impact corporate profitability, because it will be meaningful. On carbon pricing, as you say, the companies that will be subject to higher carbon pricing, and I think this is going to be the topic of conversation at COP26 in November. It will be difficult to thrash out who's to blame as such. I think there's an international relations angle to this as well that we do need to keep an eye on. But nevertheless, I think we will see some movement on agreeing a common carbon price, and that is going to raise the costs for some companies. Now, I think many companies that are at the forefront of this are aware. So particularly you are seeing some energy companies with good transition plans in order to move towards renewables in order to escape this increase in costs. But then there are some that aren't. So as I say, as an investor, differentiating and understanding how this is going to impact profitability is absolutely essential.
Is this transition going to be broadly inflationary, Karen, given the amount of money that needs to be spent to allow that transition to take place?
I think in the short term, Anna, probably yes. It's a tough question, though. I think one of the things that's quite encouraging is if you look at the cost of sourcing from renewable energy, so whether that's the cost from solar, from wind, in the last 15 years, it's come down dramatically. So relative to the cost of some of these fossil fuels, it can in fact be cheaper for certain utility companies, for example, to actually set up new plants using renewable energy rather than traditional energy. So that's encouraging in terms of this not being, us having to source a higher cost source of energy and therefore being overall inflationary. But as you say, I think in the short term, it is going to require a lot of infrastructure to electrify our systems more broadly. We may be able to source that energy more cheaply from renewables, but we need to then change our infrastructure so that we're powering off electricity. And I think that's that investment required, as well as some of the bottlenecks and some of the technologies, the battery technologies, for example. It feeds into the metals and the commodities story that is obviously pervasive in markets at the moment. I think that probably does, in the short term, add to inflationary pressure.
We're going to see the next generation EU, the spending plans attached to that EU bond raising being approved shortly. Italy and Germany, I think, to be approved this week. Those spending plans, of course, will include a lot of investments that are supposed to be green, and infrastructure is part of that. Is the best opportunity, Karen, for this here in Europe? Are you waiting to see more detail about the US infrastructure plans? What's the assessment?
I think globally, I'm not sure I think there are certain companies in Europe that are at the forefront. They're sort of the current winners or the current leaders. I think Europe is more heavily domiciled, so 3/4 of wind turbine companies are domiciled in Europe, for example. So I think Europe does have a lot of the leaders worth looking at. But I think, honestly, Anna, the headline obvious green investment opportunities, the market's already there. And if anything, some of those valuations maybe look a little stretched. I think the opportunities really lie in going downstream the technologies. So perhaps not the wind turbine companies themselves, but who are the suppliers into the wind turbines? So I think it's not the obvious plays. We need to do our research on finding those opportunities, but I think they're abundant. But I think actually they are spread across the globe.
Okay, Karen, really good to speak to you. Thanks very much. Karen Ward, JP Morgan Asset Management's EMEA Chief Market Strategist. Karen will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Let's get a Bloomberg Business Flash. Some of the top corporate stories we're covering today. Here's Laura Wright.
Thanks, Anna. Several large Chinese banks are said to be restricting credit to China Evergrande Group amid mounting concerns about the developer's financial health. Sources say 3 banks with billions of dollars in combined credit exposure to Evergrande have decided not to renew its loans when they mature this year. In a response to questions from Bloomberg, Evergrande denied lenders were curbing access to funding. ExxonMobil is said to be preparing to cull white-collar jobs at U.S. offices. Bloomberg has learned a performance evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. The company behind Soho House, a members club for creative industry executives, has filed for an IPO in New York. Membership Collective Group owns 28 clubs and 9 workspaces around the world, including the Ned, a vast hotel complex in the city of London. The company, which is yet to make a profit, says it plans to use the IPO proceeds to pay down some of its more than $800 million of debt. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright in London. Coming up on this programme, the European Commission is set to approve Germany and Italy's recovery plans. We'll get details of those spending proposals next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
International spillovers from US inflation can be amplified if people in the euro area shape their inflation expectations also on the basis of developments in the United States. Overall, however, the effects on euro area HICP inflation are expected to be moderate. As the recovery is gathering pace, we need to remain vigilant and ensure that policy support continues to provide a bridge over the pandemic and well into the recovery.
That was the European Central Bank President Christine Lagarde speaking with lawmakers at the European Parliament. She reiterated her view that accelerating US inflation will have only a limited impact in the euro area, something that we talked about a lot in the last hour of this program. Now, the European Commission is set to approve today the recovery plans put forward by countries including Italy and Germany. The German Chancellor Angela Merkel and Italian Prime Minister Mario Draghi met in Berlin yesterday to discuss the upcoming EU summit. The two leaders emphasized the importance of cooperating on political subjects such as migration. Joining us now from Brussels is Bloomberg's Maria Tadeo. Maria, so a lot to focus on today then with the approval of these budgets expected. We saw the two leaders then from Germany and Italy meeting. How in sync are they in terms of policy?
Yes, Anna, you know, it's interesting because Angela Merkel and Mario Draghi were meeting yesterday in Berlin. They've known each other for a very long time, specifically at the time where Mario Draghi served as the head of the European Central Bank. But now the dynamics are changing. Mario Draghi is now serving as a politician, and Angela Merkel is, well, on her way out, and Germany is facing a re-election. So the balance of power there, to some extent, changing now. It is interesting, too, that yesterday we heard from the Germans and the CDU put out their program in which, you know, they stuck to this very German line saying, you know, fiscal responsibility, the debt break, all of this should be in our manifesto, and it's something that we continue to defend. And it's just coming a few days after Mario Draghi, but also Christine Lagarde, as you play in that clip, said that there is still very much need for stimulus to get to a full recovery in Europe. Another thing that struck to me yesterday as interesting from that meeting between the two of them is that it wasn't just about the economy, it was really about the policy and the politics. And one of the big issues that we're going to see at the end of the week when European leaders meet here in Brussels will be about migration. And migration, Anna, as you know, this is a subject that in Italy is very touchy. It's a very sensitive topic. Italians do feel that to some extent they have had to deal with the migration crisis summer after summer almost by themselves. And Mario Draghi wants to put an end to that. You know, he wants to get some type of migration deal before this summer. Having said that, it does look like that is going to be very difficult. So I wouldn't really expect any breakthrough this week.
Right, so we'll keep an eye on that on the politics front. Sticking with Italian politics domestically then, Maria, is Italy starting to think about Mario Draghi being here for the long haul, whatever long haul means in an Italian political context? But how likely is it that he actually manages to stay for the full term as Prime Minister?
Yeah, well, you know, Anna, this is becoming a real conversation because, as you know, in 2022, the president of the Republic will leave that job. He says he doesn't want to run for another term, and there is a huge debate as to who is going to replace him. Now, of course, in the Italian Republic, the president does have power, but is seen as an institutional figure, especially relevant whenever there's an election and a new government needs to be formed. But when you look at the executive action and the day-to-day basis of politics, it is very much still down loan to government, the fact that the recovery fund is going to span out in a number of years until 2026 also means that perhaps Mario Draghi could decide to not go for that job and actually try to stay and complete a term until 2023. But this is a conversation that will really shape, to some extent, Italian assets, because you're looking at another year of Mario Draghi or potentially an election to come. So that will certainly be a key point.
Yeah, certainly something to watch when we think about how well he's respected by financial markets, I suppose, and what that maybe has meant for some Italian assets, as you highlighted last hour. Maria, thanks very much. Bloomberg's Maria Tadeo with us live from Brussels. Let's check out where we are on the European equity market session then, because this time yesterday we were seeing, well, we had seen a heavy sell-off and we were sort of pivoting back to a more stable level. Today, the European equity market picture looks fairly flat by comparison. The Stocks Europe 600 pretty flat, the FTSE 100 making some modest gains, modest losses though over on the Xetra DAX. And in terms of the handover into the US session, things look flat there really. I mean, NASDAQ futures showing a little bit of weakness, down by 0.1%, E-mini futures and Dow futures though fairly flat this hour. And we have gone from that period of a rethink of the reflation trades to perhaps going back to some of those reflation trades and thinking, well, yes, the Fed might be hawkish, the Fed might be about to withdraw some stimulus, but it's not about to do it tomorrow, and it's not about to do it very quickly. So we'll watch that conversation with interest as ever. Coming up on this program, we get back to the Qatar Economic Forum and hear exclusively from Alphabet's CFO, Ruth Porat, joins us. She'll be talking about Google's cloud business and the use of AI. That conversation coming up right here on the European Market Open. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend now, but in the kitchen I have many friends.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open, half an hour into Tuesday's session. Things deteriorating just a little, perhaps. We are now unchanged on the CAC 40. The FTSE 100, though, keeping its head above water. And if we have a look at what's going on the sector breakdown, you can see part of the reason why. Anywhere where we have a heavy weighting to energy stocks might not be doing so badly today. And so as we see that the energy sector is the biggest gaining here in Europe, up by more than 1%, in fact, by far outperforming the next best performing sector, which is real estate. We have oil prices actually retreating a little bit, but maybe there's an interest in this sector as an inflation hedge, as part of the reflation trade. We seem to be back to some of those themes after our doubts of yesterday. Technology, the worst performing sector today, down by 0.7%. Now, the former U.S. Treasury Secretary, Steven Mnuchin, has given his predictions on America's economic growth at Bloomberg's Qatar Economic Forum.
I would say clearly in the foreseeable future, I mean, we could easily see 6 to 8% growth. I think the other area, and the previous panel commented on this, is the risk of inflation and how that plays out. Now, inflation is good for certain parts of the economy and very bad for other parts of the economy. So I do worry, as Larry Summers and others have said, that the chances are higher as opposed to lower, that this is ongoing inflation and that the Fed will need to adjust for that. I think in the interim, there'll be businesses that are growth businesses, high margin businesses with consumer spending that will do very well with higher inflation, and businesses with lower margins and high costs of labor are going to be concerned. So I think the inflation outlook is something that's going to need to be managed very carefully.
Well, let's talk about managing carefully, because it appears that the Fed is coming around to the view that at least has to be concerned about inflation. That's what we heard from the Fed after the FOMC meeting. We heard Chair Jay Powell say we're paying attention now to inflation, even though they didn't take specific action. Do you think that what the Fed is doing, basically in indicating down the road they're going to have to tighten some, do you think that that's going to be enough to rein in the danger of inflation?
Well, I have a lot of confidence in Chair Powell, and we worked obviously very closely over the last several years. Clearly, what the Fed did last year during the pandemic really helped, and it was critical. So there's no question that the Fed needs to go into a period of normalizing rates and normalizing the portfolio. And I think the question is really how quickly they do that and how they do that in an effort to control inflation. I think the issue is that the Fed is being cautious. The Fed models, the Treasury models, economic models really are not very good at predicting, given the vast amount of fiscal and monetary response we had over the last year. So I think this is something that needs to be watched very carefully. And I do think the markets are underestimating this risk.
That was former U.S. Treasury Secretary Steven Mnuchin speaking at the Qatar Economic Forum, powered by Bloomberg. And let's get a Bloomberg First Word News update. Laura's here with that. Laura.
Thanks, Anna. The US says 150 Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, a study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a new record. The UK has formally started negotiations to join a trans-Pacific trading bloc as part of its bid to diversify its commerce after leaving the European Union. International Trade Secretary Liz Truss says membership of the group, whose 11 members include Canada, Japan, Mexico and Australia, would be a glittering post-Brexit prize. Hong Kong's Apple daily newspaper may be forced to shut down this week, with parent company Next Digital blocked by police from accessing its bank accounts. One of the most prominent voices of the city's pro-democracy movement, National Security Police, arrested the paper's top editors last week. If funds remain frozen, a final print edition could be distributed this Saturday. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Now, Alphabet CFO Ruth Porat says the company is excited about their investments and opportunity in Google's cloud business. She spoke exclusively to Bloomberg's Eric Schatzker about the company's future in the digital world at the Qatar Economic Forum.
There has been a dramatic acceleration in the digital transformation. Trends that were playing out over a number of years have really been telescoped in, and you can see it in commerce, you can see it in content, entertainment, education, you can see it in telehealth, you can see it even in the way we're having this conference today and the way we all work. And I think one of the important points for everyone is that we don't see the clock turning back. We do see that these trends will continue to endure, and I think it's really important for each one of us to consider how we can embrace digital tools and technology to support both revenue opportunities and efficiencies in our own business. So, for example, and to your question, when we look at small, medium businesses, which are the backbone of economies, what we saw during the pandemic is 1 in 3 small businesses said they would not have survived if they did not have digital skills, because it enabled them to immediately pivot and find their customers where they were in the online world, to get them the information they needed to talk about things like delivery or changed hours. And so these digital skills were absolutely imperative for survival.
The race, I would call it a race, to deepen relationships with customers and consumers is a fiercely competitive one. What is Google doing strategically or tactically, perhaps, that is different from what your competitors, the Microsofts, the Amazons, and the Facebooks are doing that you think ultimately is going to play to your advantage?
You know, one of the main things that we're focused on is how can we stay close to our users and customers and provide them with the tools and skills that they need to be most effective as the world continues to accelerate in this digital transformation. And our ability to leverage differentiated AI has been helpful for all of our customers, for users. You know, people don't even appreciate how often they're using AI in every day. So for those of you who are traveling around the world and opening up now to more travels, when you look at natural language translation, that benefits from AI. When you're asking the question of how do I get to find a store near me that's offering the services or products I want, again, we benefit from AI. So on the user side, really critical. On the enterprise side, what we're really excited about is the investments and opportunity in our cloud business. And our cloud business really is benefiting from extraordinary data analytics, the AI behind that, and then we've brought in talent to focus on very industry-specific solutions. So, for example, in financial services, my old home, one of the key pain points was always the manual intensity around risk and risk analytics. We can leverage things like Know Your Customer or anti-money laundering with AI and data tools. So those are important, and we go to customers and it's like, here's how we can help either with revenue upside or efficiencies leveraging the tools that we have. Same across retailers. They're looking at how can they ensure that they've got the best supply chain management when we've all lived through what we've seen. And so again, the benefit of AI. So we're looking across the board. I would say the other element of it is how can we be most supportive to the communities in which we operate, and part of that is ensuring that we're working around the globe to provide digital skills training to people so that everyone can participate in this rapid digital transformation.
That was the Alphabet CFO, Ruth Porat, speaking with our colleague Eric Schatzker, talking about the way that Google differentiates itself. Coming up then on this program, slow going. Global financial hubs are struggling to return to the office. We take a look at the situation in different cities around the world. I'm here in London, live shot of Singapore for you. How are businesses around the world in some of these global cities managing to get people back to the office, or not just yet? We'll track that story next. This is Bloomberg.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome back to the European Market Open. 41 minutes through Tuesday's session. Modest losses for European equity markets this hour, down 0.1%. Here's a Bloomberg Business Flash. Here's Laura.
Thanks, Anna. Global Foundries is to build a $4 billion chip-making plant in Singapore, slated to start in 2023. Choosing Asia for the site for its latest expansion, the US-based company joins rivals in growing capacity to help address a persistent shortfall for chips for everything from cars to smartphones. The move comes despite Biden's administration calling to bring semiconductor manufacturing back to the US. ExxonMobil is said to be preparing to cull white-collar jobs at some U.S. offices. Bloomberg has learned a performance evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. Global banks like HSBC and Standard Chartered are ramping up hiring ahead of the Wealth Connect link between China and Hong Kong. The scheme will allow investment across the border and could open up more than $460 million in annual fees for lenders. HSBC is set to hire up to 400 people in Hong Kong, while Standard Chartered is looking at hiring or promoting 3,000 Asia wealth managers. The company behind Soho House, a members club for creative industry executives, has filed for an IPO in New York. Membership Collective Group owns 28 clubs and 9 workspaces around the world, including the Ned, a vast hotel complex in the city of London. The company, which is yet to make a profit, says it plans to use the IPO proceeds to pay down some of its more than $800 million of debt. Anna, I think if Matt Miller is a customer, surely there's some chance of them making a profit in the future.
Yes, I'm sure that's some kind of indicator. I'm never seen in such places. Laura, thank you very much. Laura Wright here in London with the Business Flash. Let's stay with the workplace theme and focus on how the global return to the office is looking. 15 months after the first lockdown, many of the world's key financial centres are still struggling to kickstart the comeback. From New York to Hong Kong, the picture really differs very widely. For more, Bloomberg's Charlotte Ryan joins us now. Charlotte, this is going to be a headache for global businesses, isn't it? Because they're seeing such different patterns, such different underlying conditions in various geographies. What are we seeing in this return to work then? What's the story?
Morning. Yeah, so we're seeing, as you say, quite a different picture in different areas of the world, and a lot of hurdles to getting people back to the office in large numbers, whether that's, as is the case in London, a lot of concern around using the public transport network and whether that's a risk for infection. And then in other areas, you've got slow vaccination ramp-ups, which are slowing everything down. And in other areas, such as San Francisco, you've got a bit of a change in mindset where companies are thinking, well, maybe we don't need to bring everyone back to the office. And so, yeah, as you say, this is quite difficult to grapple with as a global firm with a very different outlook in the different cities of the world.
Yes. Yeah, indeed. So the pattern varies, the picture varies depending on where in the world you are. What are the big obstacles then? What are the big barriers to bringing people back? I mean, here in London, we talk a lot about the Delta variant and looking at the way that is growing in other places. We might not be alone for after a while.
Yes, I think the main hurdles are basically the speed at which the vaccination campaigns are rolling out, and then increasing concerns about these new variants, and particularly the Delta variant. So in London's case, you know, we were expecting to have this full reopening in June, but that has now been pushed back to July as a result of concerns over that variant.
And we've also done a focus. Obviously, you mentioned what's going on in London. We've looked at other European cities and other European countries. How quickly Germany is vaccinating, of course, will be crucial. How quickly many countries in Europe are vaccinating will be crucial in helping people get back to the office, should that be what businesses decide to do. So how quickly are we seeing vaccination ramp up?
Yeah, so there is, you know, Europe generally is moving a bit more slowly than, for example, the UK, and we know there's a lot of controversy and politics behind that. In the case of Frankfurt, it's still quite a low vaccination rate at the moment, but they are expecting that to ramp up in the coming weeks. So certainly for Germany's financial centre, that vaccination rate is a significant hurdle at the moment. I think it's around 25% of people are fully vaccinated as it stands.
Charlotte, thanks very much. Bloomberg's Charlotte Ryan. And you can read the full story, the full article on your terminal. Type NI Big Take to get the latest Big Take story. And we bring you a new Big Take story every day. So keep across those. Coming up here on this programme, though, Treasury yields steady ahead of Fed Chairman Powell's testimony. More on that next. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European market open. 50 minutes into a trading session that looks a little bit more sluggish than it did, down 0.2% on the Stoxx 600. Ray Dalio says he doesn't think the Fed can tighten more without a big negative effect. The Bridgewater Associates co-chairman and co-CIO spoke on Monday on a panel at the Qatar Economic Forum.
There's something like 10% of GDP stored in financial assets that's going to be coming out. And so it's likely that there's going to be a big pickup in demand, and that will probably raise prices significantly. And it also depends how you count for inflation, because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things I think are, and if you went to a 3% inflation rate or some bounce, that's not one of those things that gets me very nervous or very excited. The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates. And they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments, that pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, like to borrow houses right now, I mean, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon. And the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
That was the Bridgewater Associates co-chairman and co-CIO Ray Dalio speaking yesterday at the Qatar Economic Forum, powered by Bloomberg. Interesting to get his reflections then on the extent to which the Fed can tighten and the extent to which the US government will have to raise more funds in debt markets. Ben Rahm, Bloomberg's Markets Live macro strategist, is with us. So, Ben, really nice to speak to you. It seems that Ray Dalio concerned about what the Fed can do on tightening without spooking markets, concerned about how high inflation might go. He's worried about monetary inflation. We've certainly seen a lot of adjustments in fixed income markets, in bond markets, on the Treasury curve to shifting expectations over the last 24 hours. Do you think we've settled down now? So yesterday we were all talking about flattening. Today we seem to have adjusted our thinking. There's more of a steepening going on, but we're also just thinking about slightly higher interest rates more broadly. Have we reached any conclusion post-Fed, I suppose, is what I'm asking, on fixed income markets, Ben?
Morning, Anna. I think definitely a more coherent picture is forming in the bond markets, no question about it, compared to where we were this time yesterday when we spoke. I mean, the markets were all over the place yesterday, and there was a flight, there was risk aversion and all that. Now, the rates, sovereign rates are ticking higher, which is headed definitely in the right direction. And Ray Dalio says, there's a lot of monetary inflation, and that is bound to manifest itself on the curve. And I think that because real rates are kind of still very negative in the U.S., particularly at the longer end, I think that we need to be prepared for a shift in the curve. So it's not going to be it's going to be a twist in the yield curve rather. And I think that the long end of the curve will outperform the intermediate and the shorter end.
A twist then, so I mean, not Operation Twist, not back to that one, Ven, but where does that twist leave us then?
That leaves us with higher rates at the front end and the intermediate part of the curve. So we are talking about 2-year yields and 5-year yields shooting up a lot higher. We have got the 5-year rate at 90 basis points, give or take. But I said earlier this week that it's going to go to 115, and I see that as a definite prospect. And over at the longer end, I think the 10-year yield is going to stay around where it is, because even though the Fed has sounded very hawkish, we haven't seen the follow-through transmission on real rates.
Okay, we'll keep an eye on that then. Ven, thanks very much. Thanks as ever for joining us. Ven Round, Bloomberg's Markets Live macro strategist, with us with his thoughts on the yield curve. You can read more of that on the Bloomberg terminal, of course. Ven and the Market Live team, MLIV Go is the function to use. That is it for the European market open. Surveillance early edition is up next. European equity markets losing their steam just a little bit as we go through this session, down 0.3%. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
We still expect GDP growth of approximately 6.5% for this year. At this point, we're probably a little bit shy of other more aggressive projections.
Of course, there's transient inflation. The important question is whether that is 6 percentage points of transient inflation or 4 percentage points.
There's upside risk to inflation. Could go higher than what I've outlined here. And we have to be ready on both sides.
You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. At ease on inflation, Jay Powell reiterates he sees price increases as transitory as the Fed chair gets ready to testify before the House today. While Brent touches $75 a barrel, equities continue to rebound. Alarm bells. The former U.S. Treasury Secretary Larry Summers says he doesn't see why policymakers are so calm on inflation, as Ray Dalio warns that he doesn't think the Fed can tighten without a big negative effect. And Bitcoin slips towards $30,000 as China continues to crack down on cryptocurrencies. Former U.S. Treasury Secretary Steven Mnuchin says virtual currencies should be more transparent. So let's get straight to our top story. Jay Powell will tell Congress the economy is growing at a healthy clip, but unevenly. Let's get straight to our top story now. Jerome Powell saying this today, so let's get straight to our Danny Berger, actually, with the very latest. So, Danny, what are you looking at?
It's definitely this chop in markets, this back and forth, this yo-yo. It really is a market that's trying to wrap its head around exactly what we're getting out of the Fed. And because we have so many speakers, not just yesterday, but throughout the rest of the week, there seems to be this dissonance among them, which makes it difficult to get a really good read. But we're starting to see the session turn more negative as we continue throughout the day. But within that negativity, there is a clear theme, and it is that unwind of the reflation trade hit pause and is now reversing more or less. You have some sellers still coming in at the 10-year. We have a yield flirting with 1.5%. It just hit that a moment ago as I was talking and is now back down. But in terms of stocks, you can see what's outperforming is the more cyclical ones in nature. We have a Dow Jones Future Index, which is trying so hard to be positive. So again, this is more those sort of reflationary stocks. Then, of course, we have Brent crude, which is dipping now under $75 a barrel after yesterday hitting that level, maintaining it for most of the morning. But as I say, we're getting more negative in terms of the tone in the market that's causing oil to fall.
Danny, we also get some, bullish calls on oil. What are analysts actually saying?
Yeah, it looks like a Benjamin per barrel is kind of the high watermark of what we're hearing from analysts. Yesterday, Francisco Bland out of Bank of America, he says $100 a barrel of an oil. This isn't the first person to say it, but it reached this level yesterday after some of the more hawkish comments coming out of Bullard. But a lot of this does have to do with supply, this really restraint we're seeing from the U.S. shale patch and OPEC. And because of that, this key spread, this is the 3-4 month spread in WTI contracts, is gone into extreme backwardation. Every single time it's hit this in the past, it has reached $100 a barrel. So it's not crazy to have that estimate. Trafigura is one of the trading houses that has that estimate. I talked to the chief economist earlier today who says he thinks that triple digits could be reached next year, Francine.
Danny, thank you so much. Danny, I know you're also coming back to talk about Bitcoin, and then I need to ask you about Bumble, actually offering a week off for everyone. So that's a conversation Danny and I will have shortly. Joining us now to talk about the markets is Jane Foley, Rabobank head of FX strategy. Jane, what we're talking about Bumble is that actually they've given a week off to all of their employees to de-stress after COVID. So I don't know who needs it, but there are a couple of people in the newsroom that could also benefit from it. Jane, no matter, what are you looking at from Jay Powell today?
Well, I think it's quite likely that he's going to push back perhaps at some of the hawkish rhetoric or some of the hawkish tone or interpretations that we saw last week. So we've seen, his prepared remarks. I think he's going to go back to this theme of inflation being transitory. But, the cat is out of the bag. And, if I might borrow a phrase from the minutes of the RBA meeting last week, it talked about a considerable amount of uncertainty whilst supply chain disruptions ease. And I think this is really something that the markets have been taking taken on board, which central bankers now, certainly the Fed, have been taking on board. We know that a lot of inflation will be transitory, but semiconductor prices might come down eventually. But is it going to be 2 years, 3 years, 5 years? And this, of course, has the risk that it impacts inflation expectations, which central bankers really do have to be mindful of. So yes, we might have a lot of transitory elements in inflation, but actually before we get prices back to normal, central bankers might have to do a little bit of work to really keep a lid on inflation expectations. And I think Powell really does have to balance that in his comments today.
I mean, Jane, last week, of course, after the Fed decision, there was a huge repricing on the markets, really a lot of unwinding of the reflation trade. What's the next catalyst for example, dollar and some of these other currencies?
Well, I think one of the themes that we've seen really emerging is does the Fed now, and particularly the movement higher in the dollar, does that make it easier for other central bankers to also become a little bit more hawkish? Now, there are certain contenders for that. I think the RBA is one. People are talking about the Bank of England perhaps as another, because, of course, we had that recent print of 2.1% on CPI inflation, and maybe even the ECB, because a lot of these central banks are looking at their currencies. They don't necessarily want a big spike in the value of their currency. So with the dollar already gone higher, perhaps they could afford to be a little bit more hawkish without really rocking the boat in terms of too much currency appreciation. So that's going to be interesting. And with the Bank of England, I think it will be interesting to see if there's perhaps a little bit of a more hawkish take from some central bankers. Everyone knows, of course, Haldane is hawkish. I don't think the market's going to be surprised if he comes out with some hawkish remarks. But what about Fleha, for instance? Is he going to be a little bit more hawkish? He was a few weeks ago. What about other members? So I think over the summer, the markets are going to be really examining other G10 central banks more closely to see if there's been a shift in their degree of dovish versus hawkishness.
So what's your take on, is it actually sterling that you see the most value in at the moment, or what's your favorite G10 currency? Or favorite pair, I would say?
Well, to be honest, I suppose, to be honest, I have been waiting for the dollar to come back. I mean, it's gone a little bit faster than I had hoped, or had anticipated. A week ago, I would have told you my 1 month forecast was euro dollar was 120, and now we're at 119. My 6 month, I think I'll leave, it was 117. So I think the dollar strength will persist, even though I think we'll get some choppiness in the near term. I think the dollar strength will persist, certainly into Jackson Hole. I think the genie is out of the bottle with respect to the Fed now. The market is anticipating that they could be one of the first central banks, maybe to move interest rates potentially as soon as 2022. So I think the dollar remains pretty firm now against a variety of other currencies. Will the Aussie dollar come back? Will the RBA become a little bit more hawkish this year? That's, I think, one to watch. I think with sterling, to be honest, I think cable is going to be moving around because of the dollar. Euro sterling is still, really quite stable in a range here. So I think it's the central banks that have the potential to become a little bit more hawkish. I think it's those currencies that I'm going to be watching most.
Jane, Bitcoin also has slipped almost 10% over the past 3 days. Now, China's continued crackdown on cryptocurrencies is, of course, stoking fears of a deeper sell-off. Further regulation of the digital currencies will be a continuing litmus test for the industry. Now, we also spoke to the former Treasury Secretary, Steve Mnuchin, and he told David Weston at the Qatar Economic Forum that transaction should be more transparent. Here he is.
I believe that many of those industries should be in the regulated world. They should follow the same BSA, the Bank Secrecy Act requirements, the know your customer requirements, and these shouldn't be the equivalent of secret Swiss numbered bank accounts. So as long as we do a lot of work, and that was being done at the G7 and G20 as well, I think the idea is to make sure we crack down on financial terrorism so it can't be used for ransom attacks and other illicit activities.
So, Jane, if you look at Bitcoin, it's around the $30,000 mark. What happens to Bitcoin from here? Is it more regulation? And is it especially just about China cracking down?
Well, China cracking down certainly, but I think more regulation. I think that goes without saying. I mean, we can listen to Mnuchin and listen to what he's saying about cyber attacks and ransoms, etc. But I think there's another element here, and this is again coming back to inflation. Central banks like to have control of the money supply. They like to have control of credit creation via the commercial banks, etc. And if we move entirely to a crypto world, well, central banks lose control of that. Now, that's one of the reasons that crypto became popular in the aftermath of the global financial crisis. It was to move away from the banking sector. But central banks are unlikely to want that to happen, without their control. So from that point of view, I think regulation is inevitable.
Jane, what happens? Is there Ethereum or something else that actually comes to take the place of Bitcoin, or is it just not a category, cryptocurrencies, that you want to be invested in right now? What is it actually?
I think that is something that is going to happen. I mean, I think we're going to have cryptocurrencies that are tied to other assets which central banks can have control of. I think this is probably the direction that we're going. But certainly if we listen to or read the reports of the likes of, say, the Riksbank this year, they don't want this to happen too fast. This could be an enormous disruptive impulse into the commercial banking sector, for instance, through DeFi, and that is something which could be a huge shock to the economy. So this is something which is going to, I think, which central banks are going to allow to happen relatively slowly. But I think we are looking at a huge shock to the financial sector.
Jane, thank you so much. Jane Foley there, Rabobank Head of FX Strategy. Now, coming up, we'll also be speaking to the New York Fed President, John Williams. Don't miss that exclusive interview at 2:30 p.m. UK time. It'll be really interesting to get his thoughts on inflation, transitory, and of course, maybe some of the inflation imported or not. From China, up next, though, we get to the Qatar Economic Forum and hear exclusively from Alphabet's Chief Financial Officer, Ruth Porat, about Google's cloud business and the use of AI. That's next. This is Bloomberg. Finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The U.S. says 150 million Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a record high. Now, the UK has formally started negotiations to join a trans-Pacific trading bloc as part of its bid to diversify its commerce after leaving the European Union. International Trade Secretary Liz Truss says membership of the group, whose 11 members include Canada, Japan, Mexico and Australia, would be a glittering post-Brexit prize. Hong Kong's Apple Daily newspaper may be forced to shut down this week, with parent company Next Digital blocked by police from accessing its bank accounts. One of the most prominent voices of the city's pro-democracy movement, National Security Police arrested the paper's top editors last week. If funds do indeed remain frozen, a final print edition could be distributed this Saturday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now let's return to the Qatar Economic Forum. And the pandemic has accelerated the digitization of industry and the workplace. We spoke to the Alphabet Chief Financial Officer, Ruth Porat, about how Google was taking advantage of this opportunity. Now she spoke exclusively to Bloomberg's Eric Schatzker.
There has been a dramatic acceleration in the digital transformation. Trends that were playing out over a number of years have really been telescoped in, and you can see it in commerce, you can see it in content, entertainment, education, you can see it in telehealth, you can see it even in the way we're having this conference today and the way we all work. And I think one of the important points for everyone is that we don't see the clock turning back. We do see that these trends will continue to endure, and I think it's really important for each one of us to consider how we can embrace digital tools and technology to support both revenue opportunities and efficiencies in our own business. So, for example, and to your question, when we look at small, medium businesses, which are the backbone of economies, what we saw during the pandemic is 1 in 3 small businesses said they would not have survived if they did not have digital skills, because it enabled them to immediately pivot and find their customers where they were in the online world, to get them the information they needed to talk about things like delivery or changed hours. And so these digital skills were absolutely imperative for survival.
The race, I would call it a race, to deepen relationships with customers and consumers is a fiercely competitive one. What is Google doing strategically or tactically, perhaps, that is different from what your competitors, the Microsofts, the Amazons, and the Facebooks are doing that you think ultimately is going to play to your advantage?
You know, one of the main things that we're focused on is how can we stay close to our users and customers and provide them with the tools and skills that they need to be most effective as the world continues to accelerate in this digital transformation. And our ability to leverage differentiated AI has been helpful for all of our customers, for users. You know, people don't even appreciate how often they're using AI in every day. So for those of you who are traveling around the world and opening up now to more travels, when you look at natural language translation, that benefits from AI. When you're asking the question of how do I get to find a store near me that's offering the services or products I want, again, we benefit from AI. So on the user side, really critical. On the enterprise side, what we're really excited about is the investments and opportunity in our cloud business. And our cloud business really is benefiting from extraordinary data analytics, the AI behind that, and then we've brought in talent to focus on very industry-specific solutions. So, for example, in financial services, my old home, one of the key pain points was always the manual intensity around risk and risk analytics. We can leverage things like Know Your Customer or anti-money laundering with AI and data tools. So those are important, and we go to customers and it's like, here's how we can help either with revenue upside or efficiencies, leveraging the tools that we have. Same across retailers. They're looking at how can they ensure that they've got the best supply chain management when we've all lived through what we've seen. And so again, the benefit of AI. So we're looking across the board. I would say the other element of it is how can we be most supportive to the communities in which we operate? And part of that is ensuring that we're working around the globe to provide digital skills training to people so that everyone can participate in this rapid digital transformation.
That was the Alphabet Chief Financial Officer Ruth Porat speaking at the Qatar Economic Forum. Stay tuned, of course, for much more from the QEF. We'll be speaking this evening with the Glencore Chief Executive Officer, Ivan Glasenberg. I'll be doing that interview. We'll be talking about, of course, the commodity super cycle. We'll talk also about greening the economy. It's likely to be one of his final interviews in the role as he leaves on June 27th. And actually, it's one of the rare interviews that he's ever given in his tenure at Glencore. Now, also coming up, slow going. Global financial hubs are struggling to return to the office. We take a look at the situation in different cities around the world. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's focus on how the global return to the office is looking 15 months after the first lockdowns. Many of the world's key financial centers are struggling to kickstart the comeback. Now, from New York to Hong Kong, the picture, though, differs widely. With the details, Bloomberg's Stephen Aarons joins us now from Frankfurt. Stephen, great to have you, and actually it's a great, wonderful quick take. So how quickly are workers returning to the office?
Well, not very quickly. I mean, obviously, it's still very hard. Management want people back because it's just shown that if you keep people in the home office for too long, they lose productivity at some point. So they really want them to come back. But of course, that's really health hazard still, especially in Germany, where there's still a law until the end of this month that's actually prohibiting people to come back unless they're essential. And so that will be lifted at the end of the month. And things could change rather quickly over here.
So what is the biggest obstacle? Is it really vaccinations that will, I guess, force people back? I mean, do companies want to force employees back to the office if they don't want to go, or do they risk losing talent because of it?
I think those are the trade-offs that they're weighing at the moment, because they don't really want to force the people to come back when they feel unsafe. But yeah, as I said, they want to make sure productivity picks up again. And vaccination has been a problem because Germany is still lagging. The effort has been picking up over the past weeks and months even, but it's still behind the UK and the US. So that's another big problem. And the Delta variant, that's so contagious and potentially more dangerous than other variants, is starting to spread in Germany as well. That could be another obstacle.
So is there a city, is there a financial center, Stephen, that is doing much better than the others in terms of getting people back to the office?
Well, I think in the U.S. it's been doing pretty well. We've heard from several U.S. banks that they're actually demanding their people to come back rather quickly. That has not happened in Germany, for example. And the U.K. was pretty much ahead, too, until recently, until the Delta variant kicked in and hit the country pretty hard. There's now a delay, and a similar prospect may be facing Germany, actually.
Stephen, thanks so much. Stephen Ahrens there in Frankfurt. Now, you can read that full article on the Bloomberg terminal. Just type NI Big Take. I mean, one of the questions that we've been also trying to figure out in the newsroom, looking at various asset managers, for example, BlackRock. Yesterday, we were speaking to the chairman, and we were talking about the fact that they ask their employees actually to disclose whether they're vaccinated or not, to say whether they come back. Can a company force you to disclose whether you're vaccinated? I don't know the answer to that in different jurisdictions. So that's definitely something we'll dig deeper into. Coming up, some EU diplomats think there are too many British films and TV shows on the continent's streaming platforms. We'll be speaking to Heather Rabatz, the chair of Garden Studios, a new film and TV studio space in London. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
on inflation. Jay Powell reiterates he sees price increases as transitory as the Fed chair gets ready to testify before the House today. Brent touches $75 a barrel. Equities continue to rebound. Alarm bells. Former U.S. Treasury Secretary Larry Summers says he doesn't see why policymakers are so calm on inflation, as Ray Dalio warns that he doesn't think the Fed can tighten without a big negative effect. And Bitcoin slips towards $30,000 as China continues to crack down on cryptocurrencies. The former U.S. Treasury Secretary Steve Mnuchin says virtual currencies should be more transparent. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 22nd of June. Now, European equities are little changed this morning. Let's take a look at what's moving under the surface. Danny Berger has all of your stock market moves. So, Danny, what are you looking at?
I have a moving-related mover, if that makes sense. EasyJet. I'm trying to make this pun work. Going to force it through. EasyJet on the rise this morning, about 3% higher. The report out from the Times this morning saying that come Thursday, the UK government is likely to announce easing of some quarantine restrictions for British travelers who are fully vaccinated. I, for one, would love that, to be able to come back and not have to quarantine. British Land also rising today more than 4%. They're, of course, the real estate company. Reports on this one that they're selling off part of their Paddington Central lands. I realize I'm doing a very UK-focused one to start here with, but Paddington Central property, it's in the center of London. It's a mixed-use space. It's very nice. It has a pergola. It has a bridge there. But anyway, reports are that they'd sell 50% of it, so that has the share price moving higher. And finally, Grand Vision. Now, they were supposed to be acquired by Luxottica, the big Italian eyewear company. They'd put a bid in, but an arbitration said that Luxottica doesn't have to go through with that acquisition and won't face a fine. The Italian company has been rethinking it because of the hit that the space has taken during the pandemic, Francine.
Danny, so I came in this morning, and this is how it happens in the morning. You kind of read stories, and then that's one that actually caught my attention last night, which is that Bumble is offering its staff a week off. And I immediately thought, I want to see what Danny thinks of it. So this is to retain staff, I imagine, because they call it, COVID stress.
Yeah, I mean, okay, so my initial thought on this was like, okay, does Bumble shut down for a week? Is everyone who wants to online date going to be in absolute chaos? Of course it's not. But, it's all these companies trying to find ways to help with burnout. But at the end of the day, I feel like a lot of people just want to be paid more. Maybe perks aren't really what matters. Maybe it's not a week off. They just want a better pay, Francine.
Yeah, I mean, maybe it's multiple choice. You can have because you've had a stressful year, you can A, have a week off, to get a pay raise. What would you choose, Danny?
Can I get both? Is that an option? No.
There you go.
Well, you know what's kind of funny, Francine? Jeffries yesterday upgraded Bumble because more people are getting vaccinated. So more vaccination equals more dates equals more use of Bumble. I love that line of thinking.
Yeah, as well. And actually, if you invest in your employees, usually you get some good returns. That's, not something you learn at the CFA, but it seems like just common sense. Danny, thank you. Danny Berger there with the very latest on the markets and also talent retention. Now, some EU union diplomats are said to have decided there are too many British films and TV shows on the continent's streaming platforms, threatening another valuable UK export in the wake of Brexit. For now, British shows are still treated as European, but if lawmakers tried to change Britain's status, it would put popular shows such as Doctor Who and Top Gear in direct competition with other global media for the remaining non-quota portion of Europe's content. Well, joining us now is Heather Rabatz, chair of Garden Studios. Now, this is a new film and TV studio space in London. Heather is also the chair of Time's Up UK, which is a charity that insists on safe, fair, and dignified work for everyone. So thank you so much for joining us today. Heather, I have a lot of questions, of course, on diversity and the much-needed diversity questions that are in film. But first, let's start with Brexit. How much of a damage would it be to UK film production if actually the rules change on the quotas?
Yes, of course it would be damaging, and our relationship with Europe has been historically very strong and very collaborative in terms of how films and television series have been developed. I think we're all trying to grapple with a sort of post-Brexit universe, as well as, of course, the impact of COVID, which is shifting so many paradigms across different markets. So I'm sure we will all engage in as constructive a conversation as possible. But I think we shouldn't lose sight of that this is a global industry that, in terms of Garden Studios, as we are engaging in many discussions, whether it be with Netflix or with others. There just is huge interest from around the world in making shows in this country, as well as the fantastic talent that is based here.
Yeah. Are we giving enough opportunity to emerging talent, to diversified talent, Heather? And actually, if we look at the last 14 months, has it made it easier or much more complicated for these, very important but different voices to come at the forefront?
I think ensuring that our industry is diverse and inclusive is our #1 priority. At Garden Studios, we house a film school which has a whole range of students from around the world, and diversity sits at the heart of our educational endeavour and what we want to see play out at Garden Studios. Harnessing the voice of women, people of colour, is crucial to this industry, and we've begun to see breakthroughs with some of the talent that is emerging both here and globally, ensuring that those stories reflect the stories that come from all parts of humanity. We have to, though, really focus on this. We have to make sure that we improve the education, the training, the support, but also open up our industry to these new voices. And there are many initiatives underway with broadcasters, with production companies, to try and ensure that we really capture those voices going forward.
Heather, has it made it worse or easier in COVID, actually? I mean, we've had a lot of discussion about diversity and inclusion in the last 14 months. Does it translate into real action, or is it still just talk?
I think it's increasingly translated into action, and you can see that through, if you just look at the recent BAFTA winner, I May Destroy You, by Michaela Cole. I think you can see some of that talent breaking through. And there's increasingly encouragement by the broadcasters. We work very closely with the broadcasters as they open up their commissioning, as I said, to new voices. Now, there's still a long way to go. We absolutely have to stay really focused and energized around what we are doing. So I do think it's more than talk, but there's absolutely no room for complacency at this moment in time. It's like we've got green shoots coming through, and we need to really drive that growth now.
So where would the growth come from, Heather? Is it, who's actually commissioning a lot of these films? I guess you always need backing, you need money for productions, and you need producers. Who do you think has more to spend and that really supports and champions some of these causes?
I think what's been interesting is how across the industry, whether you're talking the streamers or the traditional broadcasters, how they've all been now thinking about what they need to do. There are more new writer initiatives. There are new writers being commissioned in ways that we didn't see before. We've seen the rise of somebody like Emerald Fennell here, who obviously recently has got global recognition for her work. So I think it's about really working at those talent pipelines and ensuring in the commissioning of films and of television series that when you look across the slate, you can see that range of voices. And as I said, I think everybody is now very mindful about this. They're thinking about it. And we just have to ensure that we all encourage each other to keep on pushing so that we do get to a position of equity. We are still a long way away from that.
Thank you so much, Heather Rabbatz, there, Garden Studios chair. Now, 500 million euros, that's how much Tikehau Capital's SPAC raised before listing in Amsterdam. It was the biggest such deal in Europe, and it had the support of Bernard Arnault and Jean-Pierre Mustier. Up next, we discuss with Tikehau's co-founder, Mathieu Chabran. If you have any questions for him, just IB plus TV Go. This is Bloomberg.
思维再次感谢曾经给我力量、给我能量的艾瑞克。
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's talk about the SPAC space with our next guest. He's Mathieu Chabran. He's Tikehau Capital co-founder. Earlier in the year, Tikehau launched a blank check company alongside the billionaire CEO of LVMH, Bernard Arnault, and the former Unicredit chief executive, Jean-Pierre Mustier. Now, the resulting company was named Pegasus Acquisition and raised 500 million euros, making it the biggest such deal in Europe since the SPAC boom took off last year. Well, Mathieu Chabran, Tikehau Capital co-founder, joins us now. Welcome to Bloomberg, Mathieu, and for once, it's not in the middle of the night from New York, so I'm delighted for both you and me. Mathieu, when you look at the SPAC space and actually this big announcement that we talked about last time you were on, are you sooner to making an acquisition? How far away is that?
Yeah, thank you, Francine, for having us. Good, good morning. Pretty delighted, to update on this market, which, as you know, has been, fairly busy beginning of the year. Then, went a little bit quieter. There are a number of initiatives in the market. And looks like, the market is finding now its equilibrium. So as far as Pegasus is concerned, I would not comment much on, potential acquisition. But what I can say is that on the back of this successful launch and successful pricing a couple of months ago, that has drawn a significant amount of interest. Because as you remember, Francine, this is the first of its kind in Europe that was issued and priced a couple of months ago. And it's a very innovative technology for many companies who might be looking to access and tap the capital market, the public equity market, without going through, the traditional IPO route and getting the benefit of the SPAC. So it's very interesting and exciting, I should say, to be leading this initiative here. As you remember, Pegasus is focusing on financial services with specific verticals on asset management, insurance, diversified financials. And as you very well know, it's a pretty busy market out there for this industry. So very excited to be taking that to the next phase.
But Mathieu, can you give us an indication? I mean, the sector you've already chosen, you've highlighted, which is what you're. It's in financial services. Would that be fair?
Yes, absolutely. That's what we said when we went public. That Pegasus, as a publicly traded, blank check, as we called it, would be focusing on those a specific sub-segment of the financial services. Again, asset management, insurance, and insurtech, and diversified financials, which can be, SaaS, payment, distribution platforms. So very busy market out there, as I said, and it's a great alternative for many entrepreneurs, sometimes, sellers, spin-off from larger conglomerate, financial services conglomerate, or from time to time, some sponsors looking to exit.
Mathieu, where do you still see value in the public markets from a PE fund perspective?
That's an interesting question, Francine, in the context of the close to all-time high valuation on many, across asset classes, I should say, but looking specifically at the public market. I mean, we passed, the 100 trillion, market capitalization, for the first time. I mean, we see all-time high, multiple on a PE basis. Here again, when it comes to SPAC, it's fairly different because what we do, remember, we're not buying a company. It's not a buyout. We're not taking control. We're actually, giving access to the public market to a privately owned company. So the convergence of this private market and public market effectively aim at getting the best execution by removing any kind of contingency in terms of pricing, in terms of market timing, and by having some kind of certainty of execution. So it's a very interesting dynamic, Francine, where you can effectively move away from the pure price focus and valuation that you can have nowadays by offering a very differentiating execution path and a runway, if I may say.
But so you extract value by a different execution path, which is, I mean, how different is it actually? Are there any specific things that you say, I take this company, sure, it's valued at very high, but I can extract value this way to give me maximum returns very quickly? Or is it much more dangerous than 4 or 5 years ago?
Well, I mean, if we step back a minute, for a privately owned company, going public, through a traditional IPO route, you effectively face, many risks, many uncertainties, and the first one is the price. We may want to start, looking at taking a company public today, mid-June, and that will take place, in December, 6 months down the road. So there is, uncertainty on pricing and execution. The investors may or may not be there, at the time, you take the company public. With the SPAC route, it's very different because the capital has been raised, so there is no uncertainty, on the capital. And as long as you agree on valuation with the entrepreneurs, the founder, again, I don't like to call them a seller because once again, they're not selling the company. Well, it's not a buyout transaction. It's effectively, converging and merging into the reverse merging into the listed entity. And that's where you can extract the value, Francine, because you're bringing, first-class entrepreneurs, managers, leaders, the backing of some very high-profile shareholders. You mentioned some of the few in the sponsors, but we raised this 500 million capital base with top-tier institutional investors, and that's a very appealing, differentiating proposal for the entrepreneurs. And then you can focus on extracting the value.
Mathieu, what's your take on asset management? So we've had so much consolidation actually in this space. Is it going to consolidate even more? Is there still going to be value created in Europe, or do you look elsewhere actually for asset managers to grow and consolidate further?
Yeah, I think we are, Francine, at a crossroad within the asset management world, and there is a defining moment between the traditional asset management and the alternative asset management. The traditional asset management is effectively all about scale. I mean, I would not name them. I mean, we all have them in mind. It's effectively about getting bigger, about, managing the cost base, fighting the compression, in margin and revenues. So it's a scale game. On the other hand, you've got the alternative asset management, which have been benefiting from massive structural tailwinds over the past 10 years. And it's a real, it's a secular opportunity where you've got all those private markets, alternative, private equity, private debt, real assets, infrastructure, growing very strongly. And so I would really differentiate the traditional asset management space to the alternative. We tend to focus at Tikeo, and Pegasus might be more agnostic, in the way it looks at it, to the alternative space, which is not only a global opportunity as far as Europe, as you said, massive consolidation opportunities. Sometimes the regulation is also a challenge, and that creates some subscale platform looking at merging or joining forces with a larger platform. So we should see more consolidation effectively, Francine, and it's a very interesting play at this time in the cycle.
Mathieu, thank you so much. Mathieu Chabran, the Tikehau Capital co-founder, stays with us, and we'll talk a little bit about aerospace. We'll talk also a little bit about sustainability. Up next, we continue our conversation with Mathieu Chabran. If you have any questions for him, just IB plus TV Go. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
We at Reliance have adopted this wholeheartedly and are transforming each one of our business lines to be sustainable, circular, recyclable, and with fully transparent environment, social, and governance standards. And I think that's a prerequisite for every business to survive as we go forward.
That was Reliance Chairman and Asia's wealthiest person, Mukesh Ambani, speaking at Bloomberg's Qatar Economic Forum. Now, stay tuned for much more from the QEF. We'll be speaking this evening with the Glencore Chief Executive, Ivan Glasenberg, in what's likely to be one of his final interviews in the role at Glencore as he steps down on June 27th. Now, my conversation actually with Ivan will really focus, and I know it will be pretty feisty and explosive, about the energy transition. So let's get back to Mathieu Chabran, Tikehau Capital co-founder, also to talk about the energy transition. Mathieu, when you look at the energy transition, I know you've actually been more involved in trying to find companies, I don't know whether it's technology or just that help with carbon offsets, but how do you see that developing, and is it one of the most exciting industries out there?
It is definitely exciting, you know, Francine, if you let me paraphrase Mr. Ambani, what he just said, you know, basically today, companies have to be sustainable to be profitable. And that is the new paradigm. You cannot escape that. All the stakeholders, you know, be shareholders, lenders, investors, customers, states, there will be no place to hide. So, you know, this opportunity is a once in a lifetime opportunity. There are some very ambitious goals that have been set by 2030. So very exciting. And, you know, there's been many initiatives announced, launched since we last talked, Francine, on your show. There is, you know, no shortage of capital. It's really about directing efficiently this capital. And this energy transition opportunity, you know, is one that no one can shy away from.
But Mathieu, where exactly do you invest? So, you know, we've all been learning a lot about these new technologies, about even battery storage. How do you find the right one that will then be adopted more than, you know, some of the other solutions?
Low carbon mobility, you know, is one effectively, and it goes beyond the EVs and the electrical batteries. It's about energy, you know, building efficiencies. Bear in mind that, you know, real estate, I mean, buildings are one of the largest GHG greenhouse gases emission cause. It's about obviously, you know, renewable production, but it's really about, you know, embedding technology to effectively get to these goals. Because keep in mind that if you want to meet the Paris Agreement goals, we have to come back to the emission level that was, you know, the 70s. And, you know, we shouldn't be scared about that, because in the 70s, we didn't have all these technology elements that we can factor in, you know, for all these challenges. So what we focus on through this fund, first in Europe, and now we announced a similar strategy for North America, for the US, is really the mid-cap profitable company that we want to take to the industrial phase. So we're not investing in early stage, in R&D or venture type of company. There is a proof of concept, and you need to take them, you know, to scale. And that's a great opportunity in itself. Obviously, the U.S. administration have stated some very ambitious goals here. So it's great that, you know, here, Europe, and hopefully with the France leadership and the Paris Agreement together with the U.S. are converging on this goal, which is once again, you know, a massive goal that collectively should aim for.
Mathieu, thank you so much. We'll also get you back also to talk about your renewed commitment to some of the aerospace sector. Mathieu Chabran there, Tikehau Capital co-founder. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin, Katie Lyons out of New York, and this is Bloomberg.
delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We still expect GDP growth of approximately 6.5% for this year. At this point, we're probably a little bit shy of other more aggressive projections.
There's upside risk to inflation. Could go higher than what I've outlined here, and we have to be ready on both sides.
You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
This is Bloomberg Surveillance, early edition with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on Tuesday, June the 22nd. Our top stories today. At ease on inflation, Jay Powell reiterates he sees price increases as transitory as the Fed chair gets ready to testify before the House today. Bitcoin slips towards $30,000 as China continues to crack down on cryptocurrencies. And return to work. The world's financial centers are struggling to get people back in the building. Kaylee, there's also this great story actually about Bumble giving a free week's holiday just because of COVID stress. So it'll be interesting to see this talent for, this war on talent with companies trying to figure out exactly what perks they can give people to retain them. But never matter, the markets are looking at Jay Powell and inflation.
Well, now I'm just standing here, Francine, wondering how I can get a free week off. But yes, you're exactly right. Focused on inflation, focused on all of the Fed speak we're getting this week, including Jerome Powell testifying in Congress today. Now, I would note in the Asian session, we did see a good deal of catching up to the gains we saw in the U.S. yesterday. Broadly positive, albeit the Hang Seng was slightly lower, down about 0.6 on the day, but Chinese equities were higher, and Japanese equities recovered almost all of their losses yesterday, down 3.3% in the Monday session, up 3.1% today. Speaking of Japanese assets, I would note that the yen is weaker against the U.S. dollar. It is above that 110 level still. And I wanted to note in the Asian bond market, investment grade dollar bond spreads tightening for a 9th straight day as investors are looking for some safety there. We're now sitting just around 130 basis points. Also, I have to put on my Asia board again Bitcoin, because it is concerns about a cryptocurrency crackdown in China that continue to weigh on that market. Bitcoin right now down below $32,000, getting closer and closer to that $30,000 level. As for what the picture looks like here in the U.S., we did see that rebound, that recovery in the reflation trade taking place yesterday. We aren't seeing really strong follow-through on that today, though. Futures pointing to a bit of a weaker open. We're down about 5 points on S&P 500 E-minis at the moment. In the bond market, we saw a massive intraday move on the 10-year Treasury yield yesterday, swinging more than 10 basis points. It did end the day around 1.49%, and we're effectively unchanged at that level right now. It is a story of broad dollar strength today after weakness yesterday, and that dollar strength may be part of what is weighing on crude. WTI futures now down about 0.75%, still holding above $73 a barrel. And of course, Matt, that is after Brent crossed above $75 a barrel, though it is off those levels now.
Yeah, Brent, the global benchmark, and people are now calling for $100 barrels in the next 12 to 18 months. Let's take a look at European markets right now. We see a little bit of a mixed picture once again. The FTSE is doing well. The Continental Index is not so much. You can see very little change there in France, but Italy is down and Ireland is up. More interestingly, maybe we see a climb again in bonds. Right now, those negative yields are getting closer to zero, right around negative 15 basis points. You can see the pound also falling against the dollar. Everything's falling against the dollar, but the pound is a bigger fall in terms of standard deviation moves than the euro. I find it very interesting, this back and forth. You know, as the Fed takes a hawkish pivot, can other central banks demur and keep their currency advantage or increase their currency advantage to boost exports? It's something they don't usually talk about, but maybe they want to do. And then lean hogs, something that we haven't talked about, focused on too much, but I mentioned it a couple times in the past few sessions because this really shows that maybe inflation is rolling over. We're seeing prices for goods, especially goods that are vital to our lives, like pork is to me, come down a little bit. So it looks like maybe the Fed was right in terms of transitory. Francine?
Live hogs, I love it. But if you look at avocados, Matt, they went up like they quadrupled. Right?
I don't eat avocados.
In the last 12 months. There you go. I don't want your diet, Matt, I think is what I would say. It's something that maybe we need to work on. We're watching inflation through Matt Miller's diet. It's not as high as every other diet in the world, especially at our age, Matt. We'll chat off air about that. Now look at what else is coming up this week, or today as well. New York City heads to the polls today to vote in the Democratic mayoral primary. Now election officials say it will be at least a week until the winner is known, so that's a big one. Lots of Fed speakers today as well. It kicks off with the Cleveland Fed president, Loretta Mester, discussing financial stability at 10:30 a.m. Eastern time. San Francisco, Mary Daly speaks at 11 a.m. Then the key one to watch, the Fed chair, Jay Powell, testifies to a congressional committee at 2 p.m. New York time. That's what Matt and I were just talking about. His prepared remarks are already catching attention. He's due to say that inflation has picked up, but should move back towards the Fed's 2% target. Now let's get more, of course, on what we've been hearing from the Federal Reserve with Bloomberg's Danny Berger. Danny, it's definitely, there's one game in town. It's the Fed and Jay Powell, and it's moved the markets for the last 7 days.
It really has, and it's a yo-yo market at this point now, really, because the market is trying to decide what is the narrative coming out of the Fed. Is it this hawkish pivot, or is it more like John Williams talked about yesterday, the need to proceed with more caution, that we're still not in the all clear? And that's certainly some of the commentary coming out of Powell's prepared remarks, continuing to hit that temporary inflation kind of drumbeat. But it also becomes difficult just to glob onto those when you also have speakers like Bullard and Kaplan, for example, again, sounding more hawkish, wanting to taper sooner. So this is what the market is confronted with. And we have more than a dozen speakers to go for the rest of the week. So this theme of dissonance among Fed members might be really the prevailing one. And as our colleague Mark Cudmore says, that might be what they want. They might want that dissonance, Matt, because it means that they have more flexibility in which direction they go if it's not necessarily a straight down the line communication. Exactly. They want that optionality.
Well, and Danny, of course, as we try to digest what each and every Fed speaker is saying, it's a lot of potential catalysts. What's it all going to mean for the bond market?
That is a fantastic question. Well, I think for the moment at the bond market, the big question lingering over it is whether that flattening trade is going to resume. Now, if you're JP Morgan, you look at this and you say what it means for the bond market is basically nothing, that nothing has changed post this FOMC. And because of those flattening trades we saw put on, because of that reflationary trade, which backed off, it's a good opportunity to go back in and bet that that reflationary trade can continue.
Danny, thank you so much. So much going on with the Fed. All eyes on inflation. I feel like I've been saying that for the last 4 months. For the next 10 months, I'll still be all eyes on inflation. We'll be watching, of course, we'll be all over inflation with that Jay Powell testimony at 2 p.m. Eastern Time. Now, Bitcoin fluctuating today, the largest cryptocurrency continuing to be under pressure amid a crackdown in China on payment services and mining operations. Let's get more with Bloomberg's MLive managing editor, Mark Cudmore. Mark, is there a target, and I know this is a very controversial question, but is there a target that actually China wants to get Bitcoin to so it's no longer viable?
I don't think there's necessarily a specific target, and I do think that, as you kind of imply, any specific targets in Bitcoin are a little bit arbitrary. But I think there are two, facets to their attack on Bitcoin. One is we know they're very concerned about financial market risks, and obviously they want to be able to monitor Bitcoin payments, and they want to make sure that people aren't using cryptocurrencies to get money out of the country. So that's one facet of their targeting of Bitcoin. The other one is the fact that China has set itself some very ambitious climate goals, and therefore, they have a quite nuanced perspective around this, but when they've got a certain industry which is using an exceptional amount of energy for no real economic gain for the country, it's an easy place to target. So I think the climate motive and the financial risks mean they're going to keep the pressure on Bitcoin for the foreseeable future.
By the way, I cut and pasted a piece of your macro view today, Mark. I thought it was fantastic when you pointed out that this allows, the Fed move allows other central banks to get more hawkish. And indeed, we've seen that, and that's going to be a marginal move higher or tighter in terms of global liquidity, and it's going to hurt maybe cryptos and meme stocks, although meme stocks, maybe they're immune to that kind of move. I want to ask, though, about oil. We see Brent touching 75, breaking through, coming back down. But I heard a call this morning that we could see $100 oil in 12 to 18 months. What do you think of this supply side issue?
So I think there's two kind of different dynamics here. One is I do find that the whole oil market has this default to just get super bullish oil at the highs. And I always get a little bit cynical when I hear these grandiose calls to the market, because there is an immense amount of supply out there that can come on the market very quickly, both from OPEC Plus and from shale suppliers who've been very restrained so far in terms of increasing their drilling. Now, the more the price goes up, the more the incentive is for them to actually increase supply. So I get a little bit worried about that. However, one thing I'll say is that I do think that the longer-term future of oil prices, and maybe I'm getting too far ahead of myself here, is going to be more similar to coal prices over the last decade. As we want to move to a greener future, we're going to invest less in kind of new supply, and that means we're going to get some really, really powerful spikes at times when the market can't react quickly enough. People thought that coal was a dying market 10, 15 years ago, but we continue to see coal just surging and having these crazy rallies every so often just because that supply doesn't react. And I can see that being the story for oil. Do we get to $100 a barrel later this year? Sounds punchy to me, given that shale supply can switch on very quickly. But I guess it looks like we're still going higher in the short term because those inventories are low.
All right, Bloomberg MLive managing editor Mark Cudmore with the short-term and long-term view for us. Thank you so much. Now, I do want to take a quick look at some stocks moving in pre-market trading in the U.S., and one of them is a tiny oil player, Torchlight Energy Resources. This is one of the latest in the craze of meme stocks. Already, as of yesterday's close, it was up 130% in a week, and we are adding to those gains this morning, up about 12.5% in early hours after getting touted on Reddit as a potential short squeeze. One of the older meme stocks, though, that seems to be falling out of favor is AMC. It looks set for a third consecutive day of losses, down 6% yesterday and off another 2% in early hours this morning. And another stock moving to the downside is Microvision after it announced a $140 million at-the-market equity facility after the bell yesterday. Investors not really liking that stock down about 9% before the bell, Francine.
Yeah, so much going on. Microvision. stock that we'll talk a lot more about during the day. Now, coming up next, Ian Shepherdson, Pantheon Macroeconomics chief economist, will talk not about copy and paste, although I want to quiz Matt Miller about his copy and paste, things instead of doing screen grab. But we'll talk about inflation with Ian. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Would be healthier, again, as we're making progress in weathering the pandemic and achieving our goals, to start adjusting these purchases, treasuries and mortgage-backed securities, sooner rather than later.
There's upside risk to inflation, could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that.
Much of the consensus of professional economic forecasters in February was that we would have inflation just above 2% this year. We've already had more inflation than that in the first 5 months of the year.
It's easy to say that the Fed should tighten, and I think that they should, but I think you'll see a very sensitive market and a very sensitive economy because the duration of assets has gone very, very long.
There are a few voices calling for the Fed to be more attuned to inflation risks, including some from the Fed itself. Joining us now is Ian Shepherdson, founder and chief economist at Pantheon Macroeconomics. Ian, is this, I mean, we're headed in that direction, right? A body in motion stays in motion unless, I guess, countered by an opposing force. I can't remember the exact Newton quote, but it looks like we're on the road, right? So what do?
Well, we're going to stay on this road. The timing is everything, of course, you know, in markets as well as comedy. And the problem is that markets, I think, are rather more impatient than Chair Powell is willing to be. What really struck me last week was how keen he was to point out the limits of his knowledge and the Fed's knowledge and all economists' knowledge and say, look, we don't know what's going to happen because we've got no precedent for anything like this. So we have to be patient. We have to wait and see how the labor market in particular evolves in response to this spike in inflation, whether it becomes embedded through faster wage growth. And if it does, then we can respond to it in due course. And markets for now seem willing to buy that idea. There are, as you just played earlier, a bunch of dissenting and more aggressive voices out there. But I think that I think Powell's approach for now is reasonable. That we just don't know. The unknowns are greater than the knowns. Having said that, I do buy the idea that we need to separate, draw a distinction between the slowdown in asset purchases, the tapering, and the eventual rate hikes which have to come at some point in the future. Because I do think that almost regardless of the inflation picture in the next 6 to 12 months, tapering is necessary, because this economy, to me, doesn't need 120 billion of Fed money every month anymore. I think that time has passed.
Ian, are you really back at Pantheon Towers? Like, are you back in the office, and does that make people less productive?
Yes.
And does that matter to the Fed?
I'm more productive in the office, especially today because the piano tuner's at home. But yes, the move back into the office is I think, is very significant. I'm expecting it to accelerate over the summer. You know, pretty much all the people I'm talking to, all my clients are talking about being fully back in over the summer and into the fall and good to go. And I think that's kind of a line that I would take for the whole economy as well, that the reopening is not complete yet. It's underway, and in some sectors it's really very, very rapid. But I think we're going to see a much more complete story by the end of the summer. And that will give us really critically important news on what happens in the labor market when the economy is fully reopened. Because nothing is more important than how many of the missing millions from the labor force come back in. Because if they don't, then we're going to have a wage inflation problem, and the Fed will be tightening not in 2023, but in 2022.
Right.
If those people do come back in and labor supply rises and it meets the demand, then we'll have a very different story. But I think what Chair Powell keeps telling us is, look, we have to wait because we don't know. And pretending that we know doesn't get us anywhere. We just have to wait.
Yeah, the question of how difficult it is going to be to get back to full employment certainly looms large. Aside from the Fed, what about other central banks? Has the Fed given them potentially more clearance to be hawkish?
Oh, I think so. I mean, the Fed actions give cover to pretty much everybody. Oh, that's kind of the way I would look at it from a UK, European perspective. From the perspective of emerging markets, it's not so much that the Fed gives you cover, it's that the Fed puts you under pressure. Because once the Fed starts talking about tightening policy or just becoming a bit less accommodative, then everybody starts to focus much more closely on what EM's doing and where the vulnerabilities are. So it kind of depends where you sit. If you're sat in an EM central bank, then the Fed's saying, hey, we're thinking about a change, you know, that's bad news. But if you're in Europe or in the UK, it gives you a bit of breathing room. It allows you to talk a bit more hawkishly. But again, even in those other developed economies, this question about labor market uncertainty is going to become paramount within the next few months. And just like in the US, they don't know either. So there's no great rush anywhere to jump onto the tightening bandwagon or even onto the less accommodative bandwagon. But there's no question that there is now an opening in the door that wasn't there a couple of weeks ago.
Ian, thank you so much. We've opened a Pandora box. We're three anchors, Ian. One actually says he's more productive from home, the other from the office. So I don't know. We'll have to debate this. I don't know where I'm productive. Maybe I'm never productive, Ian. Is that, I'm like, you know, I'm baffling to economists. Ian Shepherdson, founder and chief economist at Pantheon Macroeconomics. Now, coming up, we'll get the view on inflation from New York Fed President John Williams at exclusive interviews at 9:30 a.m. in New York, 2:30 p.m. in London. And this is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And the U.S. says 150 million Americans, or over 45% of the population, have been fully vaccinated against COVID-19. However, a study reports the highly contagious Delta variant is spreading in southern states, which have lower inoculation rates than the rest of the country. India, meanwhile, vaccinated 8.5 million people yesterday, a new record. The UK has formally started negotiations to join a trans-Pacific trading bloc as part of its bid to diversify its commerce after leaving the European Union. International Trade Secretary Liz Truss says membership of the group, whose 11 members include Canada, Japan, Mexico, and Australia, would be a glittering post-Brexit prize. With pandemic restrictions now being lifted across the country, companies are taking different approaches to retain staff and boost productivity. Some expect a full return to the office, while others are being flexible. Companies like Goldman Sachs and JP Morgan are requiring all vaccinated employees to be back at their desks this fall, whereas Apple and others plan a hybrid work-from-home strategy. Dating app Bumble temporarily closed this week, giving its workers a, quote, much-needed break to recover from COVID-19 burnout. And the company behind Soho House, a members club for creative industry executives, has filed for an IPO in New York. Membership Collective Group owns 28 clubs and 9 workspaces around the world, including the Ned, a vast hotel complex in the city of London. The company, which is yet to make a profit, says it plans to use the IPO proceeds to pay down some of its more than $800 million of debt. And I just found out I am officially the least cool member of Team Surveillance Early Edition, because both Matt and Francine are Soho House members, and I am not. Matt, can I get a referral?
Yeah.
Yeah, no, I mean, you would be a way cooler member than either one. Soho House would much prefer to have you as a member than either myself or Francine. So maybe we'll just transfer our memberships to you. You know, the cool thing is, so members can buy, or the uncool thing, members can buy shares, but they can't, but you can't if you're not in America. If you don't live in America or the UK, you can't buy shares, so I'm out. Yeah.
Speak for yourself. You can transfer your membership. Kaylee and I will go. The problem, Kaylee, is that you can't find a table anywhere to the cool places. So actually, I hope their IPO is more successful than their booking system, is all I will say. Coming up, Thanos Papasavas from ABP. This is Bloomberg.
morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, you know, those things have to be, you have to be mindful about that. But yeah, I think it's incredible what's been achieved so far, but you know, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lack in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, a lot going on. We haven't even talked about Bumble, Matt, actually offering employees a week off because of the stress they've had to deal with in COVID. I don't know whether that's because they worried about, you know, losing their employees, but we also have a big take, which is fantastic, looking at the different financial centers and what banks are trying to do to get people back in the office and retain talent.
Yeah, it wasn't very stressful for me, I have to say. I think I chose the perfect time to have a baby because I can't go out and do anything anyway. So I found it pretty relaxing.
Matt Miller.
Berlin's fairly empty. No one else is in the office. You know?
Yeah, I've had to homeschool. Kaylee, I mean, you've been coping okay.
Yeah, and I've also been in the office pretty much the whole time, barring 2 weeks in April of last year. But Matt Miller always just more chill than I am, Francine, I have to say. Let's talk about the markets, though. Pivoting from this conversation, of course, we did see a rebound in the reflation trade yesterday. It does seem that maybe some of those reflation trades will be outperforming again today, but we aren't seeing that lift continuing in the broader equity markets. In Europe, the stock 600 down by about 0.1%. And here in the U.S., with about 4 hours to go until the opening bell, futures are in red territory. We're down less than 2 points on S&P E-minis, but still not a gain that we're looking at. In the bond market, we saw that wild swing yesterday, more than 10 basis points intraday on the U.S. 10-year yield. Right now, we're basically unchanged, just shy of the 1.49% level. And I have to note Brent as well, because earlier it was making headlines for crossing above $75 a barrel. It has dipped back below that now, trading at $74.42. A stronger dollar may have a little bit of something to do with that. Also, it didn't fit on my board, but Bitcoin is heading down toward $31,000 today. Concern about mining crackdowns in China, and that is weighing on some crypto-tied stocks in pre-market trading. Marathon Digital down about 2%, as is Riot Blockchain. And of course, we have to mention some meme stocks as well. The latest in the fad is Torchlight Energy, up 130% over the last week, looking set to add to those gains come the opening bell. It's up about 14% in early hours, and Context Logic is higher by about 3.3%, Matt.
All right, well, we're watching Bitcoin very closely because it'll be interesting to see, Kaylee, if it hits 30,000 and bounces off, or if it breaks through and that's then a trigger to sell. It's very technical and there are not a lot of fundamentals. I'm not sure how much the Chinese mining crackdown really is moving it, and it's not just a little bit of a momentum issue. I have something that may play into a Bitcoin reflation, or certainly into risk asset reflation, from David Costin and his team at Goldman Sachs. For those of you, I should say, listening on radio, typically I'm a radio listener. I much prefer it to television, but we have charts on television that you can't see on radio. And this one is really good. Dan Curtis put this together for me from our production team in New York, and as I said, it comes from data out of Goldman Sachs. The blue line here shows share buybacks in the S&P 500. Remember how big share buybacks were driving the market through 2018? And then they just kind of fell off, not a cliff, but rolled over a hill and really dropped down in terms of a market driver. The white line here is cash on the sidelines, and this is just amazing, climbing higher and higher, in this case represented by money market fund assets at more than $4.5 trillion. Costin and Goldman Sachs say there's more than $5.5 trillion of cash on the sidelines, and that 500 billion of that is going to go back into risk assets, back into the stock market through year end. The majority of it, Goldman Sachs says, through corporate buybacks. So Thanos Papasavas joins us, CIO and founder at ABP Invest. And Thanos, I just want to ask, is this enough to drive the market higher? Because so far, year to date, we've only had, less than 200 billion in corporate buybacks. If we get another $500 billion, does that mean we're off to the races again?
Well, I think the market will be, good morning, Matt, by the way. I think the market will be focusing a little bit more on any potential trajectory changes in the Fed and any potential risk of financial conditions tightening later on this year and early this year. So I think that will probably have priority in terms of the markets. And also, if we look at other levels of indications, such as margin debt or levels of margin debt and valuations, they still tend to be quite elevated. So I wouldn't be as positive as that.
So what do you think we're going to take from the Fed then? I mean, even if the tone turns a bit hawkish, they're still buying 120 billion a month, and that doesn't look to slow down anytime soon, regardless of what Kaplan has to say. Do the markets take solace in the fact that the Fed is still there, at least through 2022?
Yeah, I think what we saw since the Fed statement last week was a relief rally. In essence, the market felt relieved that the Fed is not stubborn, is aware, maybe a little bit behind the curve, but certainly there to take action as the underlying data changes. And our view, Matt, is that we are not in a temporary or a transitionary phase of inflation. We believe that inflation is here, is coming back. We're not going to have an inflationary crisis like back in the 1970s because we have the tools and the credibility to deal with that. But still, we're going to have elevated levels of inflation, especially in the US and then followed by the UK. So I think that the Fed will gradually start shifting its trajectory very close to the end of this year and early start of next year as all cylinders start working in the US economy in Q3, Q4.
But Thanos, are markets just buying time to see fundamentals? And so do they want to know what kind of inflation we're looking at, or they're just waiting for indication for the Fed of what they'll do next?
No, I think the markets don't believe that we're going to be having an inflationary issue. I think the markets are basically saying, well, we had so much money being thrown at us after the global financial crisis. We have the same demographic issues. Technology prices go down. I don't think the markets believe in inflation. I think that's the reason.
But Thanos, there has been a pretty aggressive repricing over the last 7 days. So if they don't believe in the reflation story, what are they believing in?
No, I think they're seeing it more as a transitory, temporary, rather than a longer-term issue. Whereas in my view, Francine, is that we are going to see the yield starting to rise, but in a gradual trajectory. And I think this will be the driver for the Fed to see how does it move away from the 120 billion a month. So I think the Fed will be first seeing to see if the trajectory is gradual and an orderly increase in yields, then they'll be able to take some foot off the gas.
Well, of course, Thanos, one of the factors contributing to these inflationary pressures has been higher commodity prices, and that is a story that is starting to change. What do you make of that?
Well, hi Kelly. We have been positive on copper from last May 2020, and reflation story, strong growth story, stimulus, China. And also later on in the year, ESG factors, the infrastructure spend and the shifts towards sort of solar. But during the last month, we realized that everything that we had been calling for was already in the price, in the market. So we downgraded our view on copper. We moved it to neutral. We did the same with oil. So I believe that, yes, we are in a commodity sort of strengthening period, but I don't expect the same sort of rallies as we have seen recently. We are already expecting that. It's in the price.
Does that same thesis apply to other cyclical assets in the equity market, for example?
Well, in the equity markets, our view has been to be neutral in the U.S. and more positive outside of the U.S. So we like Europe from a valuation point of view. We like the U.K. We continue to like China, an equity view we have held consistently since 2018. And within the U.S. market, we recently wrote some analysis about a shift from growth to value, partly because of the higher yields we expect, partly because of the higher inflation, and also an uptick in terms of overall levels of growth. So I think all of these factors will be shifting growth towards value within the US market, but overall neutral US versus others, European and global.
Thoughts on the car makers, Thanos? Always interested to know what people think about Volkswagen, BMW, Ford, General Motors, v. Tesla.
No, unfortunately, I'll disappoint you on that. Unfortunately, Matt, no particular view on a bottom-up particular corporates themselves. But as a reflation, as a strengthening trade, I think that's important. Also, in my view, although there are Sino-US tensions which will continue, I think that the European relations with China will continue to be more constructive than what potentially President Biden would have liked. So I think this is unlikely to dampen the export-import relations between China and the Europe.
Thanos, what about tensions in cryptocurrencies? Are you fully invested in Bitcoin?
No, I'm not, Francine, for a very, very simple reason. It's that we would have liked to see what Bitcoin does over an economic cycle, over a business cycle, to see correlations, whether it's with growth, with inflation, with other asset classes. I can see why people choose to allocate some portion of their assets in that. It's on the back of price. But in terms of valuations and fundamentals, we have not seen it through a cycle. So we're sort of stepping back, waiting to see how that pans through and consider it over the next economic cycle or two.
All right, Thanos, thank you so much. I think Matt Miller was briefly a billionaire because of Bitcoin, but no longer. Thanos Papasavas, their Chief Investment Officer and founder at APP Invest. Now, coming up, global financial hubs are struggling to return to the office. We'll take a look at the situation in different cities around the world. That's coming up next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
If you want to have sustainable growth, it must be inclusive growth. It's not just the right thing to do, but it supports economic growth for the long term. And so one of the areas that we've been very focused on, as I've already noted, is ensuring that everyone has equal access to the opportunities for jobs of the future, the jobs of today and the future. And those are going to be digital based.
That's the alphabet, Google. A lot of people still call it Google. Chief Financial Officer Ruth Porat speaking at the Qatar Economic Forum. Now, 15 months after lockdown to ward off COVID-19, some of the world's key financial centers are struggling to get employees back to the office. Well, with more on this wonderful big take story from Frankfurt is Bloomberg's Stephen Ahrens, who helped write the story. Stephen, thank you for joining us. Now, we talk about this day in, day out. Different people are going to different speeds. There's a clear message from top chief executives saying, to preserve culture, I want people back in the office. Is it working?
Yeah, well, it's, as you said, it's working at different speeds. Clearly, executives want their staff back in the office, but they can't change the facts on the ground, the pandemic facts on the ground. If the pandemic is still there, then they have to contend with that. And so we've seen places like in Asia, Hong Kong and Singapore, which have been more successful returning people to the office than the U.S. and certainly Europe, Germany, where I'm at present. It's been lagging.
It's interesting that there was a UBS study out showing that 88% of executives want their employees back in the office, but only 40% really think it's about preserving the culture. They just want to get those bodies back because they don't believe you're doing as much work at home. Isn't that the case, Stephen?
I don't think so, to be very honest. I do think people have been seeing that working from home does preserve productivity to a certain degree, but at some point, if people are only working from home, it does erode. So they want people to come back to spend some time together, just to, to feel the office culture. Also, I think it's important to actually see clients again. That's an important point. It's not just the office, it's traveling too, meeting clients, winning the pitch in person rather than by Zoom. Those are important considerations, even for the executives.
What about the talent retention consideration? If you have one job potentially being offered to you that is going to allow you to be flexible to work from home, and the place you're working now says, no, you have to be in the office 5 days a week, doesn't that create a bit of an issue?
It's a tricky question. I guess when you're a junior, when you're, for example, a recent graduate and you're looking at your first job, I think you do want to spend some time in the office because it's very hard actually to get to meet people, even your own colleagues from home. It's very hard to learn about the office culture when you're working from home. So I think most graduates are actually quite eager to go to the office. Whether they're comfortable working there 5 days a week, that's another question. But I do think banks are trying, at least companies generally, banks are trying to offer a certain degree of flexibility, but I think they want people, especially junior ones, to come in.
By the way, a lot of banking stories today, Steve. Yesterday we saw HSBC wants to revamp its U.S. investment bank. They're hiring 50 new employees there. What's the story with HSBC coming back on the IB side in the U.S.? They just pulled out of consumer banking, right?
That's right. They're trying to sell a lot of retail business. They just offloaded the French retail business to Cerberus. They're also trying to figure out what to do with their U.S. retail business, but they are trying to maintain a strong investment bank. It's a bank under reconstruction. It's going through a big, ambitious turnaround program right now. I think the question what they will do with the investment bank and whether that effort will be successful is still to be answered.
Thanks so much, Stephen Ahrens there on this great big take story. You can actually, if you're a Bloomberg terminal customer, just go into NI Big Take and you can find this great story. Every day we put the spotlight on a wonderful story that we talk about often or not, but it's kind of fleshed out in full. Right, we have some breaking news out of the European Union. It's opened Google antitrust probe over some online ad tech. Now, they have investigated or looked into Google in the past. Remember, just I think 2 or 3 weeks ago, they were also looking at Facebook and the likes. We don't know yet exactly what they're targeting or how big the fine could be, but we understand right now that the EU is opening a Google antitrust probe that could frankly last for years over online ad technology. Coming up, more from Bloomberg's Qatar Economic Forum, rethinking the global economic landscape through the lens of the Middle East. Well, the focus, of course, will be on the Boeing chief executive, the Shell chief executive, the Glencore chief executive. I know I'm speaking to Ivan Glassenberg a little bit later on, a rare interview. He's usually pretty feisty, so I'm looking forward to it. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated. All the world is possible.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I look at Bitcoin in particular as digital gold. And so if you're going to be long gold, Bitcoin's a better version because it's got the same macro tailwinds, but it's also very early in the adoption curve, right? People were scared of Bitcoin a few years ago. They've moved into the space, and now hedge funds are okay with it. Real money managers are okay with it. Insurance companies are okay with it. And so you're playing an adoption game and you're playing a macro game. And so I'm still a big buyer of Bitcoin.
Galaxy Investment Partners CEO Mike Novogratz talking his book there at the Qatar Economic Forum, Francine. So he says, I'm in, you should be in too.
Yes, we should be. I mean, Tom's fully invested in Bitcoin. I don't know whether he was on Reddit yesterday or not, day trading. Tom, you really got to stop that. Co-anchor of Bloomberg Surveillance joins us now. I know you're looking forward to, of course, hearing from Jay Powell, and you have great guests coming on.
Well, I'm waiting for Matt Miller to tell me Bitcoin's linked to Brent crude, because that probably makes as much sense as gold. We've got really important guests coming up. Julia Coronado will join us, and Francisco Blanche, not alone, but really assertive about $100 a barrel Brent. That's a long way from a 75 print this morning as well, and a Honda come by on the equity markets. Mr. Chad of Deutsche Bank as well. And the chart's real simple. You go up to 100, and then what's great, Francine, is you adjust back to $65 a barrel. Up you go to 100, slightly below the average price of 110-ish that we had a number of years ago. And then shale oil comes on, and Blanche makes clear it's I like this, it's transitory oil. Maybe someday we can have transitory Bitcoin.
Maybe transitory.
I think we've seen that.
What is it, transitory oil?
Transitory oil is supply and demand, has some real malleability here because of the technology of shale. Price goes up, and then shale comes on with a vengeance, boosting supply and bringing the price down to $65 a barrel. Blanche has a great phrase, work from car, which is why we're going to go up to $100 a barrel. Things have changed, Francine, and particularly in America, there's going to be a lot of people back in their cars. That's the Bank of America guesstimate this morning.
Yeah, we also spoke to the head of oil at Trafigura. And Tom, I have a great chart which needs the keen treatment, actually looking at Brent crude, the most expensive against the Middle Eastern oil in 21 months as we see the recovery, of course, increase. Tom, thank you so much. Arbitrage, Tom Keene, co-anchor of Bloomberg Surveillance. We have a packed day ahead. I know there's a lot, writing on, of course, politics, finance, and the economy. Kaylee, what's on your radar?
politics, Francine. The New York City mayoral election primary is today. Voters heading to the polls. And of course, the primary is crucial because whoever emerges as the winning Democratic candidate in all likelihood will become the next mayor of the country's largest city, because this is a city that runs really deeply blue. Brooklyn Borough President Eric Adams could maybe be considered the front runner, but really it's still anyone's race, especially because there's this new system of ranked choice voting at play. So it allows people to select as many as 5 candidates in order of preference rather than just one. So it will be very, very interesting to see how these results shake out, Matt.
Can't be as blue as Washington, D.C., right? But I'm watching the nation's capital as Rob Portman, Republican from the great state of Ohio, goes in with a group of bipartisan congresspeople to try and pass an infrastructure deal. We could hear as early as today whether the White House is down to clown or reaffirms its opposition to the group's plan. But we're talking about a much smaller package, less than $600 billion, I think 579. My eyes are glued to NICNG or NIEXE to watch and see if we actually make some ground today.
Yeah, and then NI, of course, US for any stories. You can IB us also on IB Plus TV Go. I like
NIUS is such a broad tent. You know, I like to narrow it down a little bit.
Yeah, it depends on who's watching us. Matt, this is what I'm watching. I'm actually watching 2 things. So first of all, the Qatar Economic Forum. I know there's a great live blog bringing us up to date with all the C-suite that we've been talking to. We've just heard from Michael Novogratz. Of course, Matt Miller brought us that interview, and he said he's still a buyer of Bitcoin and prefers the digital currency to buying gold. I think earlier we also spoke to the Binance Holding Chief Executive. We heard from Larry Summers, and then later today we hear from Shell about the energy transition. I'll be also speaking to Ivan Glassenberg of Glencore, one of the rare interviews, and maybe his final interview at Glencore since he's stepping down at the end of June. The other one, and of course, Matt and Kaylee, this is the one thing that we've been constantly talking about throughout the markets, is Treasury traders are really looking to Jay Powell to provide some calm after a volatile few sessions that have sent yields on what one bank described as a roller coaster ride. So investors are hoping to get a little bit more clarity when he testifies to the U.S. Congress on the pandemic response and the economy. I don't know if we'll get it, but certainly we've seen some written remarks prepared for the testimony where he was pretty cautious on inflation.
You know what else is very cool, Francine? Farrow is back in the chair. So the surveillance team is complete again. John Farrow returns to our airwaves today. I'm very much looking forward to that. I will be watching the next 3 hours of surveillance.
Just in time, yeah, for the UK football game this evening. I don't know if they're doing great, but I know Farrow will be on top of all football news as well. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
We have an economy that's really strong. It's not normal to have rates at these low levels.
What the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
Given the rise of inflation, the hawks are more willing to show their hands.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Don't call it a comeback from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity price action is Tuesday morning. We're down about 0.1% on the S&P 500. TK, Chairman Powell, up a little bit later this afternoon.
Yeah, Chairman Powell, some important comments. He'll be looking at Dow futures negative 34, 33,727 on the Dow, John. And John, to me, the number one statistic out there, which goes to Francisco Blanch later in the show, is we get a 75 print on Brent crude.
And Mr. Blanch of Bank of America throwing around a triple-digit number, Tom, 100. He's got to back that up a little bit later.
It's a well-written note. He makes no bones about it. We're going to go to 100 on demand, demand, demand. Yeah, I love his phrase, work from car. But then we come back. You know, I think the time continuum here is so important. Whether it's transitory Powell or transitory Francisco Blanch, there's an ebb here. The media gets into a panic about a given trend. Blanch says up to 100, down to 65.
You throw shade at the media, Tom. Let's talk about the market participants as well
shade at you,
in the last couple of weeks. Can you believe that people are prepared to shift their outlook on a subtle shift over at the Federal Reserve? Well, are we really talking about a year out based on last week's price action?
It's a lot. You got a lot in there, John. And the answer is yes, there's been an overreaction, but there it is, and we adjust. And I would suggest without yesterday's adjustment up in equities, you're right. It was not good. But, you know, it's ebbed and flowed over 2 or 3 days to maybe, not stasis, we're not there yet, but we're getting there.
Big adjustment in the bond market as well, Lisa. Your 10-year, 147.68.
Yeah, and perhaps it was an overreaction. Perhaps it was just a really good excuse for people to get out of certain positions, reset as they head into the second half of the year. To your point, though, I think that this is the key issue, the fact that there is more dispersion among the Fed members, but it doesn't necessarily mean the leadership's on board with a more hawkish tilt. In fact, they are doubling down on some of their more dovish rhetoric, John.
I'll catch up with President Williams a little bit later with Mike McKee. We'll do that at 9:30 Eastern. Got to remember how to do this. On the S&P, where are we? 4,200, exactly where we were 3 weeks ago when I left the building. Almost 4,200 on the S&P. Futures down about 0.1%. In the bond market, yields 147.68. Come and get a couple of basis points this morning. Ahead of Chairman Powell later.
Nothing's happened since you were gone.
And in foreign exchange, euro dollar 118.86. Lisa, stronger dollar through G10 this morning.
Okay, now the markets can actually get started. You're back, so we can actually see some direction, maybe. Today, we do have the New York City Democratic mayoral primary election. This really is basically the election, since the Democratic candidate usually does win. The key aspects here, number one, are that this is a ranked choice election. So when all the people are petitioning you on the street corners, they say, if you don't vote for our candidate for number one, vote for him for number two. And that's what you see. How will this work out to try to get a candidate that perhaps appeals to a broader swath of potential voters? Also facing New York City, the biggest city in the United States, how do you recover from a pandemic that's absolutely decimated the workplace culture as well as the population? 1 p.m., the U.S. is planning to sell $60 billion of 2-year notes. Tom Keene loves bond auctions, so I am going to go into detail. The reason why I care about this is because of the huge move that we saw upward in these yields in particular. You could see how it just climbed, surged up to the highest level since March on those more hawkish comments by a select few regional Fed presidents. How much will this turn into something that perhaps is a bit messier. 2 p.m., the Fed Chair Jay Powell will be testifying to a House subcommittee. The question that I have is, how much will he double down on a dovish tilt to emphasize that he and the likes of New York Fed President John Williams actually very much see this as transitory drink? There's the whole idea that they do expect inflation to come back down, as reiterated, frankly, in inflation expectations and break-even rates. And John, this to me is the question, this partition between the leadership of the Federal Reserve and the marginal